Alright, so this is the third video in the series, Why Health Insurance Does Not Equal Healthcare. And going along from our original example, we had 100 boats in this insurance pool, and the risk of it sinking was 1 in 100. The cost would have been $100, and the premium is 105. All right, so now we have some other boat that comes along. Boat number, we'll just say it's boat number 101. And boat number 101 is a nice new boat. Everything's fine. The driver, he's there. But the one problem with this boat is this guy who drives the boat, who owns the boat, he likes to have a lot of extra cargo on the boat. Extra cargo. Now, a couple of things about extra cargo. Extra cargo changes the risk profile. So the odds of the boat sinking in a storm now become greater. So instead of 1 in 100, okay, now it's maybe 2 in 100. And so the original policy, which was written for $1.05, was based on a 1 in 100 chance of the boat sinking, but it was based on conditions X, Y, and Z being no extra cargo. And so this person comes along and says, hey, I want to get insurance. Now, the insurance company could do a couple different things. One, it could say, look, you know what, you have a higher risk, so now I'm going to charge you 115, maybe, let's say, instead of 105 for your premium. And in a bigger example of tens of thousands of boats, you know, they would be able to do that based on the math. But another thing they could say is, look, you know, we're not gonna cover you. You know, you're being reckless, and we don't want you as a client. And now the driver might get really mad, and he might think this is unfair that the other boats get to be covered, and you know, why can't he get covered? And the insurance companies say, look, you know, if you want to get covered, it's real simple. Just get rid of your cargo. Get rid of your extra cargo that you're carrying, and then you can get the $1.05 policy, and you know, then everything would be fine. So you know, the driver has the ability, they have the choice to remove that extra cargo and not be reckless, and then they can get the policy. Now, if they don't remove the cargo and they say, yeah, I'll remove the cargo, but I'm really not going to remove it, and now let's say that the boat sinks, right? It's out in the storm, and they recover the boat, and they discover that there was extra cargo. Well, the insurance company's going to say, and the owner of the boat's going to say, well, give me my $100 because my boat sunk. And the insurance company's going to say, well, whoa, wait a second. You bought a policy that said no extra cargo. And so, you know, normally we'd pay you out 100, but guess what? You know, you're paying this premium for 105 and no extra cargo. So guess what? You're out of luck, buddy. You don't get the $100. Now, some might think that's unfair. Oh, the driver, maybe he was just being stupid, or he forgot to take the extra cargo out, or whatever the case may be. Oh, big bag insurance company, they're picking on the little fisherman who's bringing extra cargo. But let's just think about this for a second. You know, if, for example, the insurance company was forced to pay out the policy anyways, or they just kind of absorb that, a couple of things would happen. You know, one, the premiums of the other boat owners are just going to go up to have to cover that. Now, in a more extreme example, you know, this is just one boat that had extra cargo. But what if there's 20 boats that have extra cargo? 20 boats. So it's 20 out of 120 boats that have extra cargo. You know, so in a worst case scenario, if all 20 of these boats, if there's more boats sinking, and the insurance company, you know, takes, let's say, 300 in premiums, and now they have to pay out 400. Well, guess what happens? I mean, they're out of money. They're bankrupt. So whoever that fourth boat owner is, and you know, maybe it's the guy with in the regular pool, and his boat sunk. That poor guy. And he's like, okay, like my premium, I followed conditions X, Y, and Z. And the insurance company's like, well, I'm sorry, but we're out of money. We're out of money because we were forced to deal with people that weren't being responsible. We were forced to pay them out, and people were not doing what they should have been doing. Okay, now in another part of explaining insurance, something that I always hear, and I think it's interesting to cover, is the idea of maintenance and service. So you have a boat, you know, and what do you need to do on a yearly basis? So let's see, yearly. You need to oil change on the engine. You need to get sealant for the hull so that it doesn't leak. And let's say for whatever reason you have to paint it once a year. Now, all these things cost money. So maybe the oil change is 5, the sealant is 5, and the paint is 5. So that's 15 total. Now, the boat owner is going to say, well, man, I don't want to pay that $15. That's kind of crazy. Okay, is there some sort of warranty or extended warranty? Now, you see this a lot. With cars offering, for example, extended warranties, and then there might be the insurance company says, well, look, man, I'm not going to cover you because look, what are the odds of you needing this? It's 100%. So if the insurance company if you were to say, look, insurance company, I would like to pay a premium so that I'm covered for my yearly stuff. Insurance company's going to be like, okay, well, let's see, there's a 100% chance of this happening because remember in our example of 1 in 100, you have a pool of 100 boats, and then you only have a premium of $1 because you're covering that big pool. But this is 100%. So in a 100% scenario, it means that, well, gee, I don't know, $15 times 100%. Well, your premium is going to be $15. And the boat owner's like, well, wait a second, I don't get it. I thought this is insurance. I thought I pay a little to get a lot. And that's true if the event is unlikely. Remember from our original video, the key to insurance is an unlikely event. Now, you might have a warranty company like, I don't know, whoever manufactures a boat or the boat dealer, maybe even a third-party warranty company. And, they might be able to offer you a warranty and say, well, you know what, for $12, we'll provide you an extended warranty. And you're thinking, well, this is great, $12 a year, and then that way I don't have to shell out 15. And then maybe the warranty company throws some other random thing in there that's unlikely to occur that, adds some extra value. But, the warranty company, the way they're making their money is probably a couple different ways. One, maybe they get the oil change, for $3, the sealant for $3, and the paint deal for $3 because they're working in bulk and they have their own shop, so they're making money. So their cost might be $9, and so they're spread, so they're making $3. $3 profit, and the boat owner's happy because he has to pay $3 less. Or maybe, for example, I don't know, 20 of 100 boat owners they don't get the sealant, and so the warranty company saves money there. Now you might be asking, well, wait a second, isn't it in the best interest of the insurance company to have the boat owners do this preventive maintenance? And the answer is yes, it's absolutely in the insurance company's best interest because ultimately if you do your oil change and you do your sealant and you do your paint, then you're going to stay closer to 1 in 100 instead of maybe 2 in 100 or something else along those lines. It's higher than 1 in 100 chance of it happening. But ultimately, the insurance policy, they could have something in here, and there could be conditions A, B, and C, and those conditions might say, look, we're assuming this 1 in 100, but you know what? In order to assume that assumes a couple things. That assumes you're doing your oil change. It assumes you get your sealant and you paint your boat. So, that could also just be part of the policy. And so now you start to see, look at this. We had this simple example of 1 in 100, and now we have conditions X, Y, and Z, and one of them is related to extra cargo. And now, oh, well, wait a second. Now we have A, B, and C. All right, and you might think, well, this is crazy. There's all these different conditions. How am I going to read the paperwork? It's really insane. But you just have to think about things for a minute because this is really all just math. It's just a mathematical equation that says, look, if the odds are 1 in 100, I'm going to charge you premium 105. But if those odds change and those odds deviate and it becomes 1 in 80 or 1 in 50 chance of it happening, for example, then that changes everything. And the worst case scenario is that there's not enough premiums coming in and the insurance company goes bankrupt. They can't pay out the people. So hopefully this video helps explain a little bit more about insurance, and also just about maintenance and warranties, just a little bit, enough to understand the different type of examples that I've presented so far in these 3 videos. And that concludes this video presentation.